Good day, everyone, and welcome to today's section. And what I'm going to be doing, what I'm going to be talking about is the general overview of financial reporting. What we are going to be talking about is what is the general overview of financial reporting. In terms of what are the different segments of this particular subject? What are the different segments of this particular subject? That is what I'm going to be That is what I'm going to be talking about. The general overview of this financial reporting. And this is one of the most simplest subject that you can that you can pass. It is very simple. For you to pass FR is very, very easy to pass because it's principle. Once you're able to understand the principle, then you are good to go. So it's a very, it's a very, very simple subject, and it is very easy subject that you can pass. It's not because I'm taking it, but as you are going on as well, you're also going to work. You also know that maybe at the end of this at the end of this class, when you are going for your exam, at least you can also testify to it as well. But it's not a course that is going to stress you. Just pay attention, understand understand the details, and God will make it easy. So just try just try your possible best. It's a very straightforward subject. It's a standard, it's a principle. The principle is there. Once you follow the principle, and that's all. And I wish you all the best when you are writing your exam. So this is what now. This is financial This is financial reporting, and this is the study text of the institute. So this is This is the institute study text, and divided into chapter 26. Don't be afraid of the number. It's not something much. So this is the syllabus this is the syllabus overview. This is the syllabus overview. And the syllabus overview, we have 1, 2, 3, 4, 5, 6. That is divided into It's divided into 6 sections. What is section A talking about? Section A is talking about conceptual and the regulatory framework in financial reporting. And I'm sure that some of us want to remember the conceptual framework is also at the foundation level. We talk about conceptual framework. And we are still going to be talking, what I'm doing now is the overview, not the in-depth or of each of these sections of the syllabus. We are still going to be talking about what are the sections, we are going to be looking at it from section by section. So looking at the word now, the first one is conceptual and regulatory framework of financial reporting. And in the conceptual world and the regulatory framework of accounting, like I make mention earlier, that some of us we are aware of some of the things that we are going to be talking about here. And what are some of the things that we are going to be talking about? We are going to be talking about what element of financial statement. Some of us, we know that already before you get to this level. What are the elements of financial statement? We have the asset, we have the liability, we have the equity, we have the income, and we also have the expenses. What are the elements of financial statement? Element of financial statement are 5. We have the statement of profit or loss. We have the asset. Element of financial statement. We have the asset. We have the liability. We have the equity. We have the income, and we also have the expenses as well. Then what are the components of financial statement as well? That's also what we are going to be talking about in syllabus section A. What are the components of financial statement? What are the components of financial statement? We have 5 components of financial statement as well. We have the statement of profit or loss and other comprehensive income. We have the statement of changes in equity. We have the statement of financial position. We have the statement of cash. And we also have the note to the account. So these are the 5 components of financial statement. The statement of profit or loss and other comprehensive income. Don't forget the statement of profit or loss. The statement of profit or loss and other comprehensive income. The statement of changes in equity. the statement of what of financial position, the statement of what, the statement of cash flow, and we also have the what the note to the account. So these are the five components of financial statement. I also make mention earlier, what are the what are the element of financial statement? Element is different from component. We have five elements as well: asset, liability, equity, income, and what and expenses. We'll also be talking about what are the quantitative characteristics. What are the characteristics of a financial statement? What are the characteristics of a word of financial information? What are the characteristics of a word of financial information? And based on this conceptual word framework, we have two quantitative characteristics. There's what we call fundamental, and there's also what we call enhancing. Don't forget. And there's what we call what? There's what we call fundamental, and there's also what we call what? Enhancing. Don't forget that. Quantitative characteristics of what? Of financial statement. We have two. We have fundamental, and we also have what? Enhancing. Those are the two what? Those are the two characteristics of what? Those are the two characteristics of financial statement. Characteristics of what? Of financial statement. We have what? We have two characteristics of what? Of financial statement. We have the word the fundamental. We have what we call the word the fundamental. And we also have that of the words the enhancing. So these are the quantitative characteristics of what of financial statement. So the fundamental is further divided into two. Fundamental is divided into how many? Fundamental is divided into two. Fundamental is what is divided into two. Is what we call relevance, and there's what we call what? Faithful representation. Fundamental quantitative characteristics is divided into how many? Is divided into two. There's what we call relevance, and there's also what we call what? Faithful representation. When we say relevance, relevance is that what financial information should be able to make a difference, should be able to make an impact. It has to be relevant. It has to have effect on my decision. That is what we call relevance. It must have a purpose. It must be useful for something. So if I'm saying relevance, is that what it should be able to impact. It should be able to impact my decision. And faithful representation has to do with what? Whatever the word, whatever the figure that you are quoting, 100 naira, it must be what? It must be true. If we are saying that, this particular item is what is 100 naira, it has to be faithfully presented. Don't mislead what user. So don't forget the quantitative characteristics of financial information. We have two: fundamental and also what we call what? Enhancing. The fundamental is two. We have what we call relevance, and we also have what we call what? Faithful representation. Then the enhancing is four. Say one, let me say two, let me say what? Three, and let me say what? Four. I can have what we call understandability, can have what we call comparability, verifiability, and timeliness. These are the words that is under enhancing. Enhancing is further divided into what? Is further divided into four. We have what we call understandability, meaning that if you want to prepare a word, if you want to present your financial statement, prepare it present it in a way that majority of the stakeholder will be able to understand. Presenting it in a way that people will be able to do, people will be able to understand. Then we also have what we call comparability. We also have what we call comparability. Comparability in terms of what financial statement should be able to be what they should be able to compare. This is what 2022. This is what 2021. I should be able to compare your performance of last year with performance of this year. It has to be comparable. The way you prepare your financial statement last year. Oh, if this is the way you prepare, I say revenue 10,000. This year, revenue is what is 25,000. I also have my cost of sales. Let's say my cost of sales is what is 7,000. Here it is what it is 2,000. So what is my what now? What is my gross profit? Here I'm having what 8. Okay. This is my what now? This is my gross profit for last year. What am I having this year? I'll be having what 18. So comparability in terms of what the way you prepare this should be comparable to the way what you prepare this one in this 2022 as your current year. So financial statement should be what the comparability should be there. I should be able to compare your financial statement of last year with this year. And another characteristic is what we call verifiability. Verifiability, meaning that what an independent individual should be able to do what an independent individual should be able to check what you are reporting in this financial statement, and we should be able to have the same results. When you are preparing your financial statement, we say that your revenue is what is 10,000. I am now within your word, I'm not within your organization now. So if I'm, well, let's say for example, I'm auditor now, I should be able to arrive at this 10,000 naira as well. What you just need to do is provide the source document that you use to prepare this. So verifiability means that whatever the word here you are saying 25, cost of sales 7,000, cost of sales 2,000. Independent individuals should be able to verify this, and we should be able to have the same result. And another one is timeliness. Try as much as possible to in communication as well. One of the characteristics of communication is timeliness. Information that you need to report as at in June, try as much as possible to release it in June, not in July. If you release it in July now, it may not be the relevance or the reliability of some of the characteristics of a good information could have been eliminated as a result of you not presenting it on time. So presenting your financial statement on time is also another very important characteristics in which the preparer of the financial statement has to take note. So these are the enhancing characteristics of the financial information. Understandability, don't forget understandability. This is comparability, this is verifiability, and this is also timeliness. So we are still going to be talking about each of them as we are moving on. This is just a general overview class. Then we'll also be talking about some concept in that's what we call physical capital maintenance, and we also have capital maintenance is we have financial capital maintenance, and we also have physical capital maintenance. So what are capital maintenance? What are the users of financial what are the users of financial statement? We'll be looking at then and what are the regulatory body will be looking about what are the role of financial reporting council in Nigeria? What are the role of financial reporting council? What is their roles and responsibility? We'll be talking about it in this particular section, A of the syllabus. We'll be looking about our regulation. What is the role of financial reporting council? What are some of the local accounting standard that is still in existence? Because before Nigeria, we have our own local accounting standard. In Nigeria, we have our own local accounting standard before. And we call it SAS. Statement of Statement of accounting statement of accounting standard. We have our own we have our own standard before. And 3 section of it is still at least 3 part of this, even though we are using But now we are using what? International what? We are using international accounting standard that is issued by what? The International Accounting what? Accounting Standard Board. So, but before Nigeria adopt international accounting standard, we have our own local standard as well. And we call it what? SAS, Statement of what? Accounting Standard. But presently, Nigeria, we are using what? International what? Accounting standard. But there are still, we still have three of our local standard that are still what the we are still using, and we have that of the what? The petroleum. We have what we call what? Upstream. In petroleum is divided into two. We have what we call the upstream activities. We also have what we call the what? The downstream. And we also have what we call the telecommunication as well. So these three standard, upstream, downstream, and telecommunication, there are three separate standards in words in our statement of accounting standard, and which are still relevant in words, despite that we are still using what? International accounting word, international accounting standard. So in syllabus section B, we'll be looking about what? Accounting standard and policy. Accounting standard and what? Policy. And these are what? Accounting standard that we're also going to be looking at. For these are accounting standard that we are going to be looking at for syllabus section B. Syllabus section A is about regulation. It's a very short chapter, and please make sure you take care of this very well. At least every time you are always going to see a question in the exam relating to what? To syllabus section B. So relating to syllabus section A, which is the what? The regulation. And it covers what? Chapter 1 and 2 of this particular what? Study text that we're looking at. Chapter 1 and 2 of this particular study text deal with what? They deal with syllabus section what? A, which is 10% of the word of the syllabus. Your chapter 1 and what? Your chapter 1 and 2, which you can see as well. This is the word. This is syllabus section what? This is syllabus section A. You can also see that the word they also include the word the chapters. Syllabus section A cover what? Chapter 1 and what? It cover chapter 1 and 2. Chapter 1 and what? Chapter 1 and 2 is syllabus section what? Syllabus section A. And you have to try as much as possible to try, make sure you understand everything that is what that is here. So your syllabus section A cover words, cover chapter 1 and 2 of this particular words study text of the institute. So now the syllabus section B is about what? Accounting what? It's about accounting standard. And what are the different accounting standards that we are going to be looking at? Some of us, we are familiar with some of them here before, because in foundation, we talk about what? IS what? 1, which is preparation of what? Presentation of financial statement. Talk about IS2 as well. We talk about what? IS7, which is statement of cash flow. And I'm very sure that everybody that is listening to me now, this is not the first time that we are hearing the word, the statement of cash flow is in foundation. If you don't have accounting background, at least you are coming from what? From foundation. So, and it's a very key subject in what? In foundation, which is what? Cash flow. This particular standard is also in what? Is also at the foundation level. IS what? IS8. IS8 deal with what? Accounting policy, changes in accounting estimate, and what? An error is also at the foundation level. Which is IS16 as well, is also at the foundation level, which is property, plant, and equipment. At least some of us that were coming from foundation or from our accounting words, maybe in our undergraduate or postgraduate, could have heard something of what? Of IS16 before, which is what? Property, plant, and equipment in terms of what? How do we calculate depreciation? What are the different methods that we can use to calculate depreciation? Whether it's straight line method, whether it's reducing balance, whether it's the sum of digits, whether it's the unit of what? The unit of asset up, which is IS16 that what? That covered. So all like this four standard now: IS1, IS2, we have IS7, IS8, and IS16. Everybody that is listening to me now, I know you all are aware of this. You all are aware of this because this particular was 9, 6, 7, 8, and 16 is also at meaning that what you could have learned it. That's why they are giving you the exemption. So the new standard that we also be looking at was starting from IS10. IS10 deal with what event after the reporting period, event after the what event after the reporting period. And we have two types of event. Please don't forget, this is just a general overview class. There's still going to be a class on each of these particular on each of this particular standard. On each of this particular standard. I'm just doing a general overview. So now our event after the one, which is IS10, event after the reporting period. Event after the what? Event after the reporting period. And let's say, for example, your reporting period is what? Is 31st of what? Is 31st of December. Let's say 2021. That is, you are reporting at this date of every year. You are reporting at what? 31st of what? Of December. But you now, let's say authorization what? Authorization date now. When you authorize your financial statement, you authorize your financial statement for issue on 30th of what? Of March 2022. This is the what? This is the cutoff date. So meaning that what on this particular date now, you send this your financial statement out to the public. Now, what IS10 is now talking about, what IS10 is talking about is that what are the events that occur between what 1st of January 2022 to what to 29 of what of March 2022. These are what we call what events after the reporting date. This is my reporting period. I'm reporting on 31st of December. And my financial statement is made available to the public on what? On 30th of March 2022. So I extend deal with what? Event after what? Event after this date. What are the events that occur before this particular financial statement is being authorized, is being sent to the world, to the public? That is what IS10 is talking about. Event after the reporting what period. And we have two types of events. We have how many types of events? We have two types of what? We have two types of events. That is what we call adjusting what events. And there's also what we call what non-what? Non-adjusting what? Non-adjusting events. So these are the words, these are the two types of events. There's what we call adjusting event, and there's also what we call what? Non-adjusting what event. Don't forget, what is what IS10 is talking about. IS10 deal with what? Oh, what are the events? What are the words? What are the words? What are the events that occur after this date? Up to the what? The day that the financial statement is being issued. That is, what are the data? What are the events that occur between 1st of January to 29th of March? That is what IS10 is what it's talking about. And I'm telling you now that we have two types of event. There's what we call adjusting event, and there's also what we call what non-adjusting event. We are still going to be talking about them in what each of these in more detail. We also have what we call what income tax, just like the very popular standard. Everybody will pay tax. Everybody will pay tax. Company will pay tax. Individual as well, you're also going to pay tax. So IS12 deal with what we call income tax. Income tax. Income tax. So let me just give you some key terms relating to this particular standard. There's what we call tax base. There's what we call what? Tax base. There's what we call carrying amount. Carrying amount. Carrying amount. And there's also what we call temporary what? Temporary difference. Then we now have what? Number 4, we have what we call deferred tax. This deferred tax is now divided into two. We have what we call deferred tax liability, and we also have what we call deferred tax asset. This is just a general overview. Okay? So don't stress yourself much. This is just a general overview. IS-12 deal with what? Income tax. International Accounting Standard 12 deal with what? Income tax. And I want you to watch to have this advanced knowledge of this particular standard, especially these key terms that what you can see on the board now. There's what we call tax base. And in simple terms, when we say tax base, let's say for example now you have a non-current asset now. Let's say you have a PPE. Let's say the PPE now, the tax authority recognizes that, oh, this 2000, that is what they recognize as as the value of this equipment, as the value of this asset. So that is what we call the tax base. The tax base is the amount that the tax authority recognizes. The tax base is the amount that the tax authority recognize. What is now the carrying amount? Everybody that is listening to me up to now, you know the meaning of carrying amount. And when we say carrying amount is what? Cost minus what? Depreciation. That is what? Carrying amount. Carrying amount is the cost minus your what? Your accumulated depreciation. So let's say, for example, now, and I have a certain asset. And the carrying amount is what? Let's say the carrying amount is 25. Meaning that this is what I recognize in my book as the value of this asset, this PP. But the tax authority is saying that it is 2000. The tax authority is saying that it is 2000. So the difference between the difference between the tax base and the carrying amount is what we call a temporary difference. Don't forget to this. Don't worry, you are still going to learn this more. The difference between the tax base and the carrying amount is what we call temporary difference. So here now, the tax base is 2000. The carrying amount is 25. The difference between the two now is what we call temporary difference. So we have a temporary difference of 500. Now, like I also make mention that we have deferred tax. So deferred tax now, it will not be the tax rate. Let's say the tax rate is what? The tax rate is 30%. So 30% of what now? 30% of 500, that would be the deferred tax. 30% of what? So, and if you say 30% of this is what? 150. So that means that the deferred tax now is what? Is 150. And don't forget, deferred tax arises as a result of what we call temporary difference. Deferred tax arises as a result of what we call temporary difference. And as we are moving on we are in the class when we are talking about why is it not a permanent difference? Because some of us can be having the mindset. Because I'm saying something now is what is temporary difference. We can be having the thought now that is there no permanent difference? Why is it that deferred tax arises as a result of temporary difference? When we are talking about IS-12, we are going to be talking about that. What I just want you to have in advance is what now? IS-12. IS-12 deal with income tax. And when we say income tax, this is the tax that you are going to pay. Individual will pay tax. The company as well will also pay tax. So the tax that we are referring to now is from the corporate perspective, not out of the individual. So I'm not explaining some basic term to you now relating to IS-12. I want you to what? Don't forget, what do we refer to as what? As tax base. Tax base is the amount that the tax authority recognizes. Carrying amount is what we have in our own book. The difference between the tax base and the carrying amount is what we call temporary difference. So it is temporary difference now that lead to what? Deferred tax. So deferred tax now is what now? The tax rate multiplied by the temporary difference. This is the tax rate multiplied by the what? The temporary difference. It will give us the what? The deferred tax of this 150. And if you look at this now, I say deferred tax is what? Is divided into two. We have what we call deferred tax what? Liability, and we also have what? Deferred tax what? Assets. D means what? Defer. T means what? Tax. L means what? Liability. A means what? Asset. So deferred tax is divided into two. Is either it is asset or is it what? Is a liability. So let me now tell you something. Deferred tax what? Deferred tax assets occur when the what? The tax base is greater than the what? The carrying amount. While deferred tax what? Deferred tax liability occur when the carrying amount is greater than the what? The tax base. Okay, so don't forget. Deferred tax liability occur when the carrying amount is more than the what? The tax base. Let's say, for example, deferred tax of assets. Carrying amount 2,000. Tax base is what now? Tax base is 3,000. So in this situation now, I will have a temporary difference of how much now? A temporary difference of 1,000. A temporary difference of what? Of 1,000. So a temporary difference of what? Of 1,000. So just know that I would not say, well, defer tax now. 30% of what? 30% of this. Whatever you have now, that is the deferred tax what? Deferred tax asset. It is deferred tax asset because the tax base is greater than the carrying amount, while the opposite is the vice versa. Don't forget, deferred tax asset occur when the tax base is greater than what? The carrying amount. While liability, deferred tax liability occur when the carrying amount is greater than what? The tax base. Thank you. And let's move on. We'll also be talking about what? PPE. At least everybody, are aware of that before. How do we calculate depreciation? How do we prepare the word property, plant, and equipment schedule? You have this. We'll also be talking about what? Accounting for what? For government grants and disclosure of government assistance. We'll be talking about what? Government grants. Government can give you a grant. So how do we what? How do we recognize the grant that a company now, a grant that you receive from federal government in your what? In your financial statement? And please don't forget, I want you to note this down as well. We have two types of grants. How many types of grants do we have? We have two types of what? We have two types of grants. We have two types of what? We have two types of grants. I is what now? I is 20. We have how many types of grants? We have two types. We have grants relating to what? Grants relating to assets. And we also have grants relating to what? To income. So these are the words. These are the two types of what? These are the two types of government grants. And we also have method as well. We also have two methods for accounting for government grant. There's what we call gross method. And we also have what we call net method. We have how many types of grants? We have two types of grants. Don't forget. We have how many types of grants? It's a very straightforward standard. We have how many types of grants? We have two types of grants. We have two types of what of grants. We have grant relating to asset, and we also have grant relating to what to income. We also have another one called what are the methods of accounting for government grants? What are the methods of accounting for government grant? We have what we call gross method, and we also have what we call what's net method. We'll be talking about that as well. Don't forget, how many types of grant do we have? Two types of grant. Grant relating to asset and grant relating to what to income. What are the methods of accounting for government grant? We have what? The gross method, and we also have what we call the net method. We also will be talking about what IS 23. IS 23 deal with what borrowing costs. IS 23 deal with what borrowing costs. And when we say borrowing costs, from the word borrowing, meaning that what as a normal layman, the cost of borrowing, Abi, you borrow 1,000 naira. You know, if you borrow 1,000 naira from me, and I'm going to charge you what's interest. This is not Islamic finance. It's an Islamic finance that we say what riba, call it what in Islam, call it interest is riba. And it's a very major sin for what for Muslim. We should not engage in such activities. Riba is not good. So we have borrowing costs. So in borrowing costs is that when you borrow now, and when you borrow, it's for to develop a qualifying what assets. It's for a what? It's for a qualifying what? It's for a qualifying asset. So when you borrow, let me do a small things here. IS 23. Let's say, for example, now you borrowed what? You borrowed 10,000 naira. And this 10,000 naira that you borrowed now is for you to develop a what? A qualifying what? A qualifying asset. Maybe it's for a construction of a what? Of a certain asset. Okay? So you borrow 10,000. And when you borrow this 10,000 naira, it's for what? It's for production of a qualifying what? Of a qualifying asset. And when we say a qualifying asset, the qualifying asset are those assets that take a what is substantial numbers of time for them to what for them to be developed. You borrow 10,000. Don't worry, don't let me use a word, a big language. You borrow 10,000, and this 10,000 naira that you borrow now is not for consumption. It's not like our own federal government in Nigeria. The federal government can borrow sometimes to pay salary. No. This particular 10,000 naira that you borrow now is for you to do what? Is for you to construct a qualifying asset. The bank now charge you, and let's say, for example, this is the total amount that you borrow, and this is the total amount that you use to develop that particular project. For you to complete that project is 10,000, and you borrow the 10,000. This is a principal amount that you borrow, and the bank now charge you what in interest. Let's say interest. This is the principal amount, and this is the interest. Interest of what? Of 1,000 naira. So what IS 23 is now telling us is that in your financial statement, you are not going to say that the cost of this asset is what is 10,000. You are going to say that it is what it is 11,000. So borrowing costs are meant for what? Borrowing costs are meant for capitalization. Borrowing costs are meant for what? For capitalization. Don't forget, borrowing costs are meant for capitalization. Apart from the words, from the theoretical part, we'll also be looking about when borrowing costs commencement of borrowing costs. We'll also be looking about what suspension of what of borrowing costs. And we'll also be looking about what cessation of borrowing costs. So when would borrowing costs commence? When would borrowing costs be suspended? When would borrowing costs be ceased? We'll also be looking about that. Don't forget, what I'm telling you now and what I want you to have at the back of your mind now is that borrowing costs are meant for what? For capitalization. Once it meets a certain criteria. Okay. We'll also be looking about what investment in associates. That is what IS 24. IS 24 deal with what related party. Related party. That is, let's say, for example, now we can have a parent company which we are seeking to look at, and we can have some other Let's say in your dad limited now. Your dad limited can be controlling what? More than one company. So related party transaction will always occur. I can buy from that what? From that subsidiary, the company that I'm controlling. The company that I'm controlling can also buy from. We can perform some certain service, maybe technical, it may be administrative service to one another. So there are some transactions that if some of these transactions occur, you have to disclose it in your what in the financial statement. You have to disclose it in your what in your financial statement. That these are what related party work transactions. We'll also be talking about what IS 28. IS 28 deal with what investment in what in associates, investment in what in associate and what and joint ventures. And I will be explaining that in what in the group aspect of this. We'll also be talking about what IS 32. We have IS 32. We'll also be talking about what IFRS 7, and we'll also be talking about what IFRS 9, because they are both what financial what instruments. Financial what financial instrument. We'll be talking about what financial instrument. It's a very complex topic. And when we say financial instruments are what instruments that from one party it is a liability, and another party is an asset. So mean that when we say financial instrument, there are two parties involved. So one party it is your asset. So another party it is a what is a liability. So financial instrument can be divided into three. Financial instrument can be divided into three. We have what we call financial assets. We also have what we call financial what liability. And we also have what we call compound instruments. Compound what? Compound instruments. Compound what? Compound instrument. And compound instrument are those instruments that have the characteristics of what financial asset, and they also have the characteristics of what of liability. So we'll also be talking about what IS 37, which has to do with what provision, contingent liability, and contingent asset. We'll also be talking about what IS 38, which is what we call intangible assets. We'll also be talking about what IS 40, which is related to what someone related to IS 16 very well. Investment what property. How do we account for what for investment property? And when we say investment property are those properties that we hold or we have just for what? Just to receive a capital what appreciation or rental income. That is investment property are those property that the main purpose of having them is to receive a capital what appreciation or to do what? And also receive a rental income. We'll also be talking about what business combination. Business combination are those words from the word business combination. Looking at the words, we have a parent company and we have what a subsidiary. When we say a parent company is a company that control another entity. A parent company is a company that control what another entity. We'll also be looking about consolidated what financial statement. We'll be looking about what IFRS IFRS 13. IFRS 13 deal with what fair value adjustment. What are the fair value what hierarchy? We have the fair value hierarchy 1, 2, and we also have 3. We also have how do we recognize what revenue? How do we recognize what revenue? That is what IFRS 15. And we also be looking at what International Financial Reporting Standard system, which has to do with what lease. So these are the accounting standard that we are going to be looking at, and looking about one, and they are more than this, but at this level, these are what we are interested in in FR. When we get to corporate reporting, which is the final level, there will be some 5 standard that will be added to this. Okay. But for now, for FR level, this is what we have. Okay. So those are the words. Those are So in the syllabus section B, we'll be looking about what IS 16, be looking about what 38, that is the tangible non-current. We'll also be looking about the intangible. We'll be looking about what impairment, which is what IS 36. And please don't forget, impairment occur when the carrying amount is greater than recoverable amount. I want you to write down down. IS 36. IS 36 deal with what impairment. IS 36 deal with what impairment. And impairment occur when the carrying amount is greater than recoverable amount. Impairment occur when the carrying amount is greater than what recoverable amount. What is now recoverable amount? We'll be talking about that. We'll also be talking about what fair value. I think that's IFRS 9, and we'll also be looking about IFRS 13 as well. Inventory and revenue, which is inventory is what 2, revenue is what is 15. Provision, we're looking about what IS 37 and 10. Income tax, IS 12, and we'll also be looking about what IS 33, which is has to do with what any per shares. Then we'll be looking about what preparation of financial statement, just like continuation of what you know before. How do we prepare what? How do we prepare statement of profit or loss and other comprehensive income? How do we prepare statement of profit or loss and other comprehensive income? How do we prepare the statement of changes in equity? How do we prepare the statement of financial position? How do we prepare the statement of cash flow, which you are aware of it before? And what are the notes in the account? So those 5 components of financial statement, how do we prepare them? We'll be looking at them in what? In syllabus section C. And the syllabus section deal with what? Group accounts, deal with what? Group account, and we'll be looking at what we call simple group at this level. Simple what? Simple group, where we have a parent, we have a subsidiary, and we also have what? Associate. And let me give you one thing. If we say what? A parent, let's say for example now, this is A and this is B. If A now acquire more than 50% of B ordinary share. Let's say, for example, now, if A acquire more than what 50, let's say, for example, now, A acquire what 51% of the ordinary share. So that means that what A now is the what? Is the parent. While B is the what? Is the sub. A is the what? A is the parent, while B is the what? Is the sub. A is the what? A is the parent, while B is the what? Is the sub. So that means that what now? A is the parent company of what? B, while B is the subsidiary. This is our percentage holding, and I want you to hold this down very well. If we have from 0 to what? 0 to 19%, that is what we call what? Ordinary investments. Don't forget. When you have what? From 20 to what? 20 to 50, this is what we call what? Associates. And when you have what? 51, more than 51 and above, this is what you call what? A subsidiary. Don't forget this percentage. It is very, very, very what's important. If you have from 1 to what? 1 to 19%, that's what we call ordinary investment. If you have from what? From 20 to 50, that's what we call associate. And when you have what? More than 50, that is what we call what? A subsidiary. Okay? Note this down. So we'll be looking about the group account, and group account is divided into, we have that of the income statement, and we also have that of the statement of financial position. Group account is divided into what? Is divided into 2. We have the statement of financial position, and we also have the statement of what? The statement of income statement, statement of profit or loss. Okay, so those are the 2 divisions, and we are going to be starting with what? Statement of financial position. We are going to be starting with what? Statement of financial position, then we'll go on to what? To income statements. We also have what? Analysis and interpretation of financial statement, where we use what? Ratio to analyze what? We use ratio to analyze financial statement. So Then we'll also be looking about what are the ethics and the current development in financial reporting. Ethics, we all know this before, and ethics cut across all the 15 subject of ICANN, starting from the foundation, the skills that you have now, and what the professional level as well. There's all this ethics, and there's a current development. So these are the overview of the words of financial reporting. Don't forget. It's divided into 6 sections. The first section is what we'll be looking about our regulation. We'll be looking about accounting standard. We'll be looking about how do we prepare financial statement. We'll be looking about preparation of group accounts. We'll be looking about analysis and interpretation. And we'll also be talking about ethics and current development in financial reporting. So these are the words, these are the syllabus overview of financial reporting. And I'm able to take you through some of the accounting standard that we're going to be looking at. It's a very straightforward subject. It is divided into, it is divided into 6 sections. Conceptual and regulatory framework, accounting standard, preparation of financial statement, preparation of group accounts, analysis and interpretation, and ethics and current development in financial reporting. So these are the general overview of the of financial of reporting. So subsequent discussion, we are going to be looking about each one of them, and we are going to start from we are going to start from group account. We'll be doing the group account, and we'll be doing the standard group account, and a standard. We'll be doing it simultaneously. So this is the general overview of it. The very words is not a very difficult subject, and it's not difficult. And I pray that at the end of the day, everybody is going to pass. And some of the things that we are talking about, we'll also be using it in your normal office activities as well. So you only cut across this particular subject cut across only passing it alone. You have to try as much as possible to understand. And I pray that God will give us the intensive memory for us to remember some of these things, use it in our exam and use it in our daily life as well as an accountant. So thank you everyone, and God bless you all. Don't forget, this is just a general overview. What are the division of financial reporting? At the end of this class now, you should be able to know that this particular subject is divided into It's divided into 6: conceptual and regulatory, the accounting standard, preparation of financial statement, preparation of group account, analysis and interpretation, and ethics and current development. So God will make it easy, and every one of us is going to pass by God's grace. So enjoy the rest of the day.